Oh, well, good to see you again, John. We're recording this on Thursday morning. Overnight, the big news was the Federal Open Markets Committee decision to keep interest rates where they are. So let's just put that into context. At the moment, the official cash rate in the US is 4.5%. We've come off a high of 5.5% from September through to December. They reduced interest rates by a full percentage point in 3 cuts. But no one was expecting a cut this time round. And basically, I've just watched the press conference from Jim Powell and from Jay Powell, and he emphasized that because of tariff uncertainty, it would be prudent to watch and wait how the economy responds. John, they did change their projections somewhat, so they reduced their outlook for economic growth for 2025 from 2.1 down to 1.7. And at the same time, they increased their projection for inflation from 2.1 to 2.5. So does that signal that there's a bit of a concern about stagflation? And how do you see that affecting markets?
Well, the market jumped last night. I guess it's just a relief rally, so I wouldn't get too excited about that. I think the first cut in growth forecast by the Federal Reserve won't be the last. So I say if the full ambit of tariff increases goes through, and we know there's more to come, then I expect that the 2 forward estimates they made, growth will come down further and inflation will go up higher. And it's an interesting dilemma when you're talking about what they do with their cash rates. As you said, the cash rates are 4.5%, which are clearly too high against current inflation readings. But if inflation is projected to go up, maybe interest rates may be more steady than anything, and cuts may not be as soon as you expect. On the other side, interest rate cuts arguably would stimulate economic activity and put a tailwind behind the economy when it needs it. So I think the commentary last night exposed all the dilemmas of the Trump policy for the Federal Reserve. And I think it suggests that markets are now caught traps. So what to speak? Markets rallied very strongly in 2024. US market, it's given up a bit of that this year. I just suggested I think the markets are just going to bounce around going nowhere until we see what happens with Trump. And if Trump continues to be aggressive on tariffs, you could probably say there might be a little bit more downside in the American market because economic growth will slow substantially.
Yeah, so I think it's quite clear that tariffs and their implementation, their delay, reciprocal tariffs, the disruption of supply lines, obviously all that creates pressure for inflation, and the Federal Reserve wants to see how it all comes out at the end of the day, and tariffs seem to push either volatility up or down. John, let's bring it back home to Australia. We've got a budget coming up quite soon. What are you expecting out of that?
Well, now we have this on balance sheet, off balance sheet, or through financial accounts, out of financial accounts sort of expenditure. So the current year is running better than expected. We know that from various announcements which have been leaked. A $28 billion deficit for FY25 is now looking in the low teens. Now, some of that will be given back by maybe the flood issues in Queensland, and obviously some election promises. Now, the thing about election promises, are they going to happen before June 30, or is some going to be immediate on budget night, put a taste in voters' mouth, or are they all going to be delayed on a trust me basis, vote for us and you get it? So I think this year's budget is fine. The projections are obviously going to be disturbed by promises. We've had the PBS promise this morning, which is good stuff, addresses cost of living, and the opposition immediately said we'll do the same thing. That'll have some issue with America, but I'm at the point where so what? You know, if they want to put up any pharmaceutical export prices to America by 20%, well then that'll be stupid for them, but if they want to do it, fine. We're not going to do that in Australia, which is exactly the right strategy. I think the budget forecast will be interesting. What are they going to forecast about economic growth? What's the forecast for inflation? Will their inflation forecast taking the cost of living relief, which is going to come thick and fast on budget night? These are all interesting things. I think we'll talk about in great detail next week, and hopefully I can get some sort of document quickly together, Paul, as I usually do on budgets, and try and analyse, go through the back pages, you know, the hidden gems in the. But it is a rushed document. We have to admit that. I mean, I think the government wasn't expecting to have a budget. Now it has to have one because of the Queensland floods. So when something's rushed, there'll be a lot more interference in the numbers. You know, they won't be as well researched. So I think there'll be some interesting mistakes made in this budget, which hopefully we can pick up when we review it.
Yeah, I just wanted to talk a little bit about the bond markets, both in Australia and in the US, because they've been particularly well behaved, considering all the uncertainty. You know, the 10-year bond rate in the US for US Treasuries has pretty much range traded between 4.25 and 4.5. So the bond market seems pretty relaxed about the outlook. In Australia, more or less the same thing, perhaps 10 or 20 basis points higher than the US at the moment. Is that giving you confidence that the forward projections for interest rates are pretty moderate? There are no major surprises that are going to kind of destroy market valuations ahead, certainly not anticipated by the bond market.
Well, they're big markets, Paul, and so is the equity market of America. You know, we're talking, $50 trillion equity market and $30 trillion bond market. I suspect what's going on in terms of direction of capital, investment capital, you've got money coming out of the equity market, which was hot money and is parking itself in the bond market and creating stability in the bond market, which is fine because that means that the downside of the equity market is restrained somewhat by the maintenance of the risk-free rate of return. When the central bank comes in and says that they expect inflation to lift under Trump, but it's still work in progress, obviously the real rate of interest is coming down before our eyes. Now, normally that would create, a disturbance in the bond market. We're not getting that disturbance because I think the hot money is parking in the bond market, waiting for some sort of sign on the equity market. Can they go back and trade the equity market? I think the central bank, as we said in the very first question, Paul, the Federal Reserve has got this wait and see approach, and I think markets are going, well, that's not a bad approach. Let's all wait and see what happens because it's too unpredictable with Trump. Does he, will he, won't he, will he change, will he pivot? Because the positioning of tariffs and the cost imposed on American consumers is going to be the driving factor for economic growth, for consumer activity, consumer confidence and inflation. We can't predict that at present because it's too uncertain.
Yeah, it's worth pointing out that the American consumer is ultimately the most important factor in the global economy. I mean, they constitute around 65 to 70% of US GDP, and because America is such a big part of the global economy, it's the single biggest swing factor. One of the things that the FOMC did as well last night, which I forgot to mention, is they slowed the decline of the reduction in the balance sheet. So their quantitative tightening program has now been slowed from allowing something like $20 billion dollars worth of US Treasuries to mature each month to about $5 billion. So slowing down on QT. Can you just explain to the audience?
Yeah. Well, they clearly don't want to compete against the new issue, the primary market, and I'll cover this off next week. I'm doing a presentation in Adelaide, which we'll talk about. But the budget of America is running towards, well over $1.5 trillion deficit, which is a 5% deficit to GDP. Now, that $1.5 trillion deficit has to be funded with primary issues. So it's a big ask for the markets to consume that, and the market to consume that wants confidence that the central bank's supportive and not pushing against it. So the reduction in quantitative, or the unwinding of quantitative easing, where the central bank sells back bonds it's previously bought, the reduction of that lowers the competition or the supply of bonds onto the market. But as you say, it's fractional. We're talking about a massive supply of bonds, and the American Treasury is trying to extend bond maturity. They're testing the waters constantly in the 30-year market. At this stage, they're getting away with it, although I read a report last week that bids are weakening in that part of the market. But clearly, if you're creating a lot of debt and you'll come inflation, if you can convince the bond market, to buy 30-year treasuries with inflation risk under a tariff war, that's a mighty effort. So I think the Treasury is working with the Federal Reserve to try and relax markets, to take as much of this long-dated debt. And as we know, Paul, if you can get long-dated debt away and inflation catches you, it devalues the debt in today's dollars. So I think it all works together, that there is a bit of a game going on to convince bond investors to take on what I regard as very poor returns and very high risk in this environment. But the market's doing it.
Well, just talking about high returns, I enjoy looking at gold because it's performing so well at the moment. So gold has broken out on the upside to a new all-time record above 3,000 US dollars an ounce, now sitting around 3,040. In Australian dollar terms, it's $5,000, which is really a terrific return for gold miners. We've been bullish gold for at least 18 months, and it provides that diversification that one doesn't get in the bond market, and also as a hedge against things like inflation, the US dollar, and share markets. At the same time, the copper price is also nudging against all-time highs. Are you bullish commodities generally, or do you think this is specific to gold and copper?
Well, there's two things happening. The US dollar has peaked. Now, that's a big call, but we've been waiting for the US dollar to peak for about the last 5 years, and certainly post-COVID. So weakening US dollar does push up the US dollar price of metals and commodities. So that's a tailwind. So we've got to think about that. But no doubt, as you see, gold is outperforming even that weakness. And to some extent, it's hedging quite nicely against US dollar. And as it continues to do that, more money flows into it, because momentum becomes quite a big issue. But I would reiterate what I said a few weeks ago when Trump declared to NATO, or directed NATO to increase their defence expenditure. And we've seen, I think, general agreement across Europe that they are agreeing to increase that investment. Now, if you think about that expenditure, if you think about it, when you invest in arms, it is real activity. It is real manufacturing, as opposed to what I call black hole investing, where you're just pouring into social security. So the mobilisation of the defence industries across Europe will be a net positive. We're looking at 30 to 50% increases in budgets across Europe. So if we go from 2% to 3% of GDP, that is significant investment in manufacturing, which consumes metal prices. And Australia, once again, is well positioned, and it'll maintain steel prices, obviously. So as America does what it's going to do and slows, it looks like Europe is going to pick up the slack. And there's no doubt that China is seeing this as an opportunity. As America somewhat destabilises its image in across the world, that China steps up. And there's indications now that China, the administration, is supporting its major corporations again. There was a period where it didn't. It's now back supporting its entrepreneurs and its major industrial companies. So every action has a reaction, and Australia needs to think about the reaction, less about the action, because we're not as exposed to America as a lot of people think. We're more exposed to the rest of the world in trade.
Yeah.
And there's growing evidence that this could be a net positive for Australia's markets. And the big issue will be, I think that the budget will trip over itself and the Treasurer will trip over himself, and indeed the opposition will trip over themselves if they don't identify the opportunity that Trump is presenting. It's a big opportunity for Australia in international markets.
Well, John, I think we'll have to end it there. Just to give a commercial for your presentation next week in Adelaide. Those viewers in Adelaide, that's going to be on Tuesday, the 25th of March. You'll talk about a lot of these topics in great detail, and the outlook for Australia and the share markets and the economy. I'm sure it'll be of great interest. So, John, thanks for that. And hopefully you get a big attendance in Adelaide on Tuesday, the 25th. I'm sure you will. Thanks, John.
Thanks for that.